Good morning and welcome to the Elite Traders Club weekly analysis session for Monday, 21st of September 2015. Certainly been an interesting week on the markets this last week. A whole lot of news. The world awaited for the Fed and their impending decision on interest rates. And at the end of all that, it was just a bit of a fizzle, really. Not a lot of market movement after the decision, but certainly some interesting observations to make on the markets of last week. Let's get underway. The disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation or particular needs. So please, before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. Okay, today, as per usual, we'll go through and have a look at what the market risk is at the moment on both the ASX and the US markets, the S&P 1500 in particular. We'll have a look at some specific setups. I couldn't, again, find anything in Australia and only a minimal number of setups in the US, and that's quite often a reflection of market conditions and what's happening with overall trends, remembering that we need three trends in alignment. And we also need to overlay our price action filter as well. So certainly very slim pickings. I'm not too concerned about that at all. The market is in either extreme or very high risk at the moment. So we certainly don't want to be bending over backwards trying to desperately search for ways to get into the market. Our whole strategy is really about finding reasons for not to get into trades and therefore filtering out any trades that are showing any weakness in price action, as an example, and then some Q&A at the end. All right, so at the moment, as alluded to, in the Australian market, we're still in extreme risk, and we'll go through and have a look at this in a moment. So as such, it means that you are only allowed to expose a very small amount of your capital. So whatever your maximum allowable drawdown is, and for most it's somewhere between 10 and 15%, you are only allowed to have 10% of that value exposed as risk in the market. So if you had a 15% allowable drawdown, that would mean at the moment you are only allowed to expose 10% of that. That is 1.5% of your overall trading capital as risk in the market. And I think that's a very good model to abide by. Certainly if you've been stopped out of trades along the way at the moment, you don't want to be adding any more. If you're new to the market and this was your first foray into it, then you would only be able to start with an exposure of 1.5%. And again, I think that's a very good thing for anybody who is new to the markets. In the US over there at the moment, we are in very high risk mode at the moment, and so therefore using a market risk multiplier of 20%. So if you were starting with 15% over there and it was your sole market that you were trading, you would only be allowed to expose at the moment 20% of your 15, which would be 3% value at risk across your entire portfolio. As you can see there, the market risk multiplier 10%. If we are splitting our capital, however, between the two markets, then half of your capital, therefore half of your drawdown, is allocated to each of the markets. So in Australia, that would mean that you have a maximum allowable drawdown of 7.5%. Because we are in extreme risk at the moment, you're only allowed to use 10% of that allowable drawdown, so 10% of your 7.5, meaning that you should only have a very small amount of value at risk exposed at the moment. And again, I think that's a very good thing. Again, trading's all about when things go wrong. In the US, by comparison, the other 7.5%, you are allowed to expose only 20% of that. And as a result, that means 1.5% of your trading capital exposed as risk in the market. Those of you who are choosing to scale out, looking for one-to-one type of targets in the ASX and one-to-one in the US as we speak, certainly we've discussed the merits of letting your profits run, and certainly there has been a number of advantages to doing that, even in these extreme and very high market risk conditions. as we've gone through a number of examples before, not every one of your trades is going to be a Capilano Honey or a Blackmores or others that keep going up whilst the market is going down, but at least if you create the opportunity, the environment for those to occur, then you can certainly benefit quite nicely along the way. All right, let's go across and have a look in Beyond Charts now and see if we can get a bit of a picture as to what's actually going on. Now, this is the Australian market, and as you would all know by now, our stochastic has really been on the downward side for an extended period of time. We are still in extreme risk territory. That stochastic is still below 20 there at the moment. So we're going to be, in either extreme or very high market risk for a period of time yet. I think it's important to also have a bit of a look at our price action, and this green line that I've put in here, this is just a 200 period moving average, which is quite often used as a bull market, bear market indicator. You can apply the same on a monthly chart using a 10 period moving average, which basically relates to the same sort of time frame. Really, you're looking at 200 days, 40 weeks, 10 months. Again, you can apply it on your charts, but it's really interesting to have a bit of a look at the price action since we've gone below this longer term sort of bull market, bear market filter. We've really now been spent a fair bit of time below that, and the price action at the moment, I discussed a little bit on the macro session the other day. We're currently in this Beyond Charts. Come on, if you can do it this morning for me. It's not going to allow me to draw a trend line at the moment. My computer does struggle a little bit trying to run lots of things all at once. And oh, there we go. Looks like we're going to be able to draw something now. Come on, Beyond Charts. I know you can do it. Oh, look at that. Just wonders don't cease. Let's go back to where we were. And with a little bit of luck, grab my trend line. There we go. And we've got this really sort of tightening formation at the moment, with price just going backwards and forwards and backwards and forwards. So at some stage, as we get squeezed closer and closer to an end point, price is more than likely going to move fairly quickly one direction or the other. So we just need to wait and see which direction that is at this point. But suffice to say that price action, we're now well below this longer term moving average. And if we go back over a period of time and have a look at the sort of price action we've got below our longer term moving average, previous occasions where we've come down below, we've bounced back up pretty quickly. That was towards the end of last year. A lot of times, this longer term moving average, it does act as a bit of dynamic support along the way, and prices come down and move back very quickly, come down and move back very quickly. And one of the reasons why I'm not a big advocate of when the market conditions do change, so as an example, we went from moderate risk here through to high risk. I'm not a big advocate of trailing your stops aggressively because market risk is changing, because many times when the market comes down to these sorts of levels, it can turn around very, very quickly and you end up being stopped out of good positions that you were in. So naturally what's going to happen over a period of time as market conditions change, then, and as they have over a period of time where we went sideways and then we started to move progressively further and further down, when this type of price action occurs, you're going to start being stopped out of some of your trades along the way. Some of those that you continue to manage in the right way will hold up because of their relative strength. And if you're fortunate enough to have some that are really outperforming, then they're really going to do some very heavy lifting during this time of broad market downturn. Eventually, all good things are going to come to an end and you'll be stopped out of those positions eventually. But the whole concept behind that is that it's helping you to stay in those trades, because we're never too sure when the market is really going to fall away quite quickly, but certainly keeping an eye on market risk as we go. So that was back towards the end of last year, that volatility, back at the beginning of 2014. again through 2013, coming down to this particular zone, responding and moving back up. And again, if you go back over those sort of time frames and look at some really strong performing stocks during these periods of market volatility, stocks like G8 Education, CSL as an example, Ramsay, those sorts of stocks that have been very, very strong through these periods despite overall market weakness. So it's been a long time since we've got below our sort of 200 period moving average. This is back in towards the mid part of 2012. Prior to that, the other previous time when we started to spend a long time below this line was during the Eurozone debacle that we had with Portugal, Ireland, Greece and Spain, where the market was, again, down in very high market risk, extreme market risk, spending a lot of time below that longer term filter. The longer term filter noticeably, bending down, moving, being dragged towards the downward side through the price action. So we're certainly not out of the woods by a long way at this point in time. For our market to start moving back up above this, our mining sector is going to have to pick up its game. The banks are going to have to pick up their game. There's all sorts of headwinds against our market at the moment. If we go through and have a look at what's happening on the US market, from the beginning of the year, you might remember the Australian market started to perform very, very well. The US market really just started to go broadly sideways, and we've commented on this a number of times. We started to get some divergence with our market risk indicator, suggesting that some weakness was likely to follow. We fell out of this sideways moving range very, very quickly. We've moved back up. The price action still is not looking particularly good. We had a classic 3-bar reversal that you'll see there the other day. This candle, that pin bar, that was the Fed news. Nothing really happened much at all. A little bit of expectation into that announcement, and then followed through on Friday with a pretty dark sort of candle. Typical 3-bar reversal. And again, this longer term moving average looks like it's starting to act as a bit of dynamic resistance in this particular case. So again, if we do the same sort of thing and just sort of zoom out a little bit and have a look, a little bit more of note with the US market, it's been a long time since this market has spent any length of time below its longer term moving average. In previous times when we have come down to that sort of level, the market's come down, and no sooner have we got down to this level and it's bounced back straight away. So again, if you were ram cramming and jamming, if you were selling half of your positions or doing whatever to reduce your value at risk, you're limiting the effect of these bounces, and you have quite a few of these bounces in any particular bull market. So probably out of about 4 bounces, you're going to get one that doesn't bounce and keeps going. But, sort of 3 out of 4 are going to start moving back up to the other side. And again, you'll see a pattern where, we come down towards the longer term moving average and markets recover along the way. So it's been a significant amount of time since price has been below that longer term moving average. And again, we're going back here into 2011, and this is Eurozone activities again. And it took quite a while for the market to recover and start to move up. And obviously we had a whole lot of QE and those sorts of things going on in the States as well. So certainly at this point in time, really need to be quite mindful of that, where we are in the broader scheme of things. The price action at the moment is looking particularly bearish. And I wouldn't be surprised to see the market at some stage roll over more towards the downward side. So that's the sort of thing that I'm looking at the moment. Certainly our market risk indicators is telling us, look, we only want to have a small amount of capital exposed to the market. So certainly don't want to be racing out there, adding to portfolios at this point in time, because things are looking certainly quite bearish at this point in time. All right, so let's go through and just have a bit of a look at a couple of the pendings or a couple of the trade setups that I found for this particular week. There were a few that were exhibiting good price action, but in terms of the actual structure of the trades, just getting out to fairly large sort of risk. So in this particular example, ABIOMed, I guess that's how you say it. Certainly, in terms of trade structure, looking really good. Trough at or above second from last peak, second from last peak. So clearly some good demand for this particular stock, good relative strength. However, by the time we get into this particular trade, we're going to end up having a risk in excess of 18%. So even just to get to a basic one-to-one type of target, it's going to have to do a lot of work. So therefore, on the basis of that, I'm not going to put it in the watch list, but I think just as an observation in terms of what qualifies as good price action, then this meets the bill. It might be on charts as got a there we go. Don't need to change that. I'll cancel that. So I've got that on there just as an entry point, and obviously we need to have a protective stop below that last medium-term trough, and as such, when you take all that into account, that's a very, very wide stop. It's going to have to do a lot of work in this current market. So I'm not going to put that one in, but just an observation that it does tick the boxes in terms of good price action, and also it's at all-time highs. So there must be something that the market knows about this stock, and we're using price action, relative strength, three trends as a proxy for the fundamentals at the end of the day. The next one, which can go in the watch list this particular week. So if you still have space in your portfolio and you are on top of your risk management, etc., then BCR, CR Bard is a stock that you could consider. In terms of price action, the last trough coming in at or above the second from last medium-term peak. There's the last medium-term peak. There's the second from last medium-term peak. Good relative strength when compared to the rest of the market. Certainly it was a little bit weak through here, this period of sideways movement. So that's really just sort of saying, look, whilst the stock was going sideways through here, on a shorter term basis, the market was actually outperforming it. And that's not uncommon when you get a period of sideways movement or stagnation, until we start to see a little bit more movement, directional movement, and that's evidenced by these higher medium-term troughs along the way. We've broken through a ceiling, so to speak. No sooner have we broken through, we've come back and retested. We've had a positive retest, so in terms of price action, ticking the boxes there. And again, we're at all-time highs. So against the broader market, you have to ask yourself the question, why is that? And obviously, relative strength is something that the stock likes about this. Certainly still got a little bit of work to do before being triggered, but as the structure of the order suggests, an on-stop order at 202 and 49 cents with a limit to 204.51 and a protective stop at least a minimum of 2 ATRs and 0.5% below that last medium-term trough has a protective stop at $180.02. That's BCR. Next cab off the rank, extra space storage. I know I could do with some of that at my house. I've got a great big double garage, and it seems to be full of my wife's hobbies, boxes and things like that. But I'm sure I'm not alone. EXR, and there's nothing the matter with having hobbies, I'm told. EXR, the price action on this one, last trough coming in at or above a second from last medium-term peak. It looks very close, so let's get out the value line and have a look there. Just move that annotation out of the way. The high of that medium-term peak is at 69.74. The low of that medium-term trough there is at 69.96, so it's marginally higher than that last medium-term peak. As such, it does meet the price action filter, so trough at or above second from last peak. Good relative strength, so it's been moving upwards, certainly against the broader market, still exhibiting reasonable sort of price action. Where are we in the broader scheme of things? Again, we're at all-time highs, so certainly there must be something again that the market likes about this. So the structure of our order on this one, on stop at $79.17 with a limit to $79.96. Protective stop coming in at $69.61, at least 2 ATRs from that entry level and at least a minimum of 0.5% below that last medium term trough. That's EXR. Next one that meets all the criteria as well is FIS, Fidelity National Information Services. And let's go and scroll out on this one and have a look. So again, we can see that we're in all-time highs. It's certainly been moving along very, very nicely over that period of time. A little bit of weakness through here on the shorter term basis as the stock started to move sideways, whilst the rest of the market during that time still had a little bit of upward direction, or alternatively wasn't moving to the downward side as much as this had through that period of time. And so therefore stock, by comparison, a little bit of underperformance on a short-term basis. Since then, obviously over the last 6 or 7 weeks in particular, really starting to find a little bit of strength, and that's evidenced by the histograms on all 3 time frames. So starting to outperform the market, which is a positive sign given what the market's been doing. As such, the structure for this trade, the last trough at or above the second from last peak, looks pretty close. So let's go through and just check on that. Make sure that we are doing our due diligence. And when I stop getting the little wheel of death there we go. So we'll put on our value line. The high there, $64.93. The low there, $65.20. So again, it ticks the boxes in terms of our price action filter. On stop order at $72.31 with a limit to $73.03. It's 1% above that level. Our protective stop outside of 2 ATRs and at least 0.5% below that last medium term trough, coming in at $64.87. That's FIS. The next one I haven't put in. It's got a much wider stop. We're getting out to 15% on this particular on the structure of this trade. In terms of price action, let's just go through and have a look. That low there, that high there is at 55.89, 55.89. And the low there is also at 55.89. So is that trough at or above the second from last peak? Absolutely, yes it is. But in terms of a bang for buck, then having a wider 15% type of stop means that you're going to end up with a, if you like, less shares with a little bit more risk on each one. It's just got to do that much more work, and at this particular environment, really trying to move against the broader market direction. I'm not going to put that in, but I've just put it up there because it does meet our price action filter. It ticks all the boxes in terms of relative strength, in terms of no overhead resistance at this point, so it is blue sky, but just a much wider stop on that one. So it certainly doesn't hurt to practice and go through and look at structures of trades and think about what that might mean for your capital along the way. The next one that does meet the bill is MD Mednax. Again, this one actually looks quite nice. A lot of white candles, again, which is something that's really nice to see as part of the overall trade direction. Good relative strength. Overall, a little bit of weakness through here as it had a bit of a pause. Typical of what happens with stocks, they get pushed along, they need to have a pause, a regroup before moving upwards again. Since then, since it's been consolidated, moving out of that consolidating type of zone, nice and strongly coming back, retesting the old supply levels, now acting as demand levels, so that's another positive for it. A couple of nice candle last week in particular. All we've got to do is move past that last medium-term peak. Now that medium-term peak you might be able to see on your screens came in at 85.57. So normally we would add a couple of pips to that, but since that particular high, we've had 2 weeks after there, we had another high. So what we're going to do is wait until we get past the subsequent high. So if you like, this is almost a medium-term peak proxy. The high there is 86.09, which was higher than our medium-term peak at 85.57. So we're going to allow a couple of pips above that medium-term peak proxy there, and we're going to enter at $86.11 with a limit to 86.44. That 86.44 is a 1% above that previous medium-term peak. So that's the figure that we're using to calculate the limit off. So the structure of the trade now means that it needs to be triggered somewhere between $86.11 and $86.44. We need to put in a protective stop at least 2 ATRs away from our entry level and at least 0.5% below our last medium-term trough, and that comes in at $75.81. That's MD, and again, all-time highs, looking very good despite the overall market weakness. And that's the end of the list that I've got for the US. I couldn't find any setups on the ASX at the moment. There were a couple of trailed stops in the Australian market. Needless to say, you can probably rattle them off the top of your head. We'll go through them in any case. CZZ, Capilano Honey, just at the end there you'll see the 3 ATR line being dragged up a little bit further. Also price volume volatility signal on that, so if any of you are still in that, as you should be, certainly an opportunity to take some profits off the table. Along the way, if you've used any of these previous price volume volatility signals to take some profit along the way, that's fine. Well done for doing that. But certainly you should still have a portion of your capital in this if you haven't already got out. My question would be, to those of you who did get out, why did you get out? We ran a workshop over the course of the weekend up in Sydney, and went on to explain to some of the newbies that 3 words I often hear when people get out. So when I ask why, the common response is, I just thought. I just thought he was going to do this. I just thought I was going to do that. Food for thought. AIA, this is just some of the other ones in the portfolio there. Auckland International Airport, no change to that one. A little bit of weakness on that recently. ARB, again, just through here, just look, it's going sideways, but interestingly, it's still exhibiting relative strength stronger than the broader market. So it's going sideways whilst the market is going down, and hence the relative outperformance there. BWP, similar sort of story there, really going sideways, trying to do its best to hold up along the way. GHC, this is one that's its price action has been really very positive for a long period of time. And you can see there that 3 ATR line has worked really, really nicely for a long period of time. So certainly along the way, if there's any particular opportunities through here, obviously the sort of price action that we really want is where those troughs are coming in at or above the second from last medium term peak. There will be some situations where you'll have a look, and certainly, way back into 2012, examples of that sort of price action along the way, where you could have actually been in this for a significant amount of time. And certainly, look, there's $1, and yes, it did pause at $1. It went sideways for a period of time, but continued to move up and up and up along the way. So, hence the value in trailing those particular stops. Lots of price volume volatility signals along the way, opportunities for you to take some profit off the table, looking for other opportunities to re-enter along the way. Again, the last 3 weeks against broad market weakness has been very, very strong, and as such has started to drag that 3 ATR line up even further. So that's on GHC, looking really, really nice at this point in time. GOZ just hanging in there. It's really not going anywhere fast, but again, it's still performing better than the overall market is. IVE, this is an ETF based on parts of Asia and Europe. Certainly doing its best to hold up there at this point in time. The jury's still out as to whether it's going to be able to turn around and move back up. Certainly we had some price action below the trailing 3 ATR a few weeks ago, beginning of September. It needs to start getting a little bit of a wriggle on. James Hardie, interesting candle last week, opening up on its highs and closing down low. Certainly 3 ATR, from a behavioural aspect, has allowed the stock to move upwards, back down, upwards, back down. So if the market continues to like it, then it's certainly been given every opportunity to move in the right direction. AZJ, Aurizon Holdings, really struggled. No sooner did we get ticked into that one, and it really started to experience a bout of weakness. It's come down, it's penetrated its original 2 ATR based soft stop, therefore was converted to a hard stop, starting to find a little bit of strength, which is encouraging again, particularly against broader market weakness as well. That's Beyond Charts playing funny games. AHD, again, if we just sort of zoom out and have a bit of a look on how this has performed, and again, a wider trailing stop has allowed the market to push this upwards. It's given it enough room for it to swing around and keep you in a trade. And just recently, really good relative strength. I'll have to fix up my analysis on this because you can see there my short-term relative strength is not showing up, even though I've got it down the bottom there. I'll have to replace it with the long-term one, but I'll do that after the session finishes. That last candle there dragging that 3 ATR trailing stop in an upwards direction as well. Really nice price action on that one. So that one's been changed in the watch list as well. APE looking quite good as well. Nice retracement, moving back up. Would have been nicer to see a little bit more follow through this last week. We've only got to get through that sort of $11 and looking really strong. MyNet Phone, that was one that exhibited, no sooner did we get triggered into that one, and then a whole lot of movement towards the other side. Nearly got stopped out a couple of times through here and has only just managed to hang on. But a nice candle 2 weeks ago, last week, could have been better. And obviously Blackmores just continues to go up and up and up. It's interesting, I read in the news during the course of the week, a company you've probably all seen on the TV, Swiss, was a company, a local-based company in Melbourne that has now been purchased by, I think it might have been a Hong Kong-based company or whatever, similar sort of desire for quality vitamins. And I was talking with Jeff Saffer literally about 10 days ago on the back of what was happening with Blackmores. I said to him, do you know any other vitamin producers that could be of interest to the Chinese market? And it was only a matter of time, and there we have it, Swiss. I've got a question coming through there from Darren. What about VEI? Let's go and have a look at VEI. VEI, Vision Eye Institute. I've actually had this in my super portfolio at a couple of stages. It's been a while since I've had it, but certainly of late. Let's go through and have a look and see if we can zoom in. Just make sure that I am on a weekly chart. That's all very good. And let's put on that. Okay. Look, certainly at this stage, Darren, absolutely. In terms of price action, so if we just go through and put on our 3 moving averages, so therefore they're all part of the scans, so is the relative strength. In terms of the price action, away we go. We've got a trough that's just been put in. Fantastic. So that trough, where is that trough in relation to the second from last medium-term peak? It's way above it. Let's just zoom out and see where we are in the scheme of things. So if we go back and have a look, what levels do we need to be aware of that might impact this right at this point in time? And you'll see through here back in 2009, it's still an important point. We haven't got past that yet. It's a long-term peak that we need to be aware of. So let's just zoom in and have a closer look at that level and put that in. So that high there is at around about $1.10. So if we go through and have a look now, we're just coming up to that level at this point. So the question remains, how close do we need to be to that long-term peak? And we need to, the first test needs to be considered at 1% within that long-term peak. So if that long-term peak is at, around about $1.10, $1.11, 1% there, then we're going to be looking at around about a cent, 1.1 cents thereabouts. Certainly we haven't come that close yet, I don't think. Let's just go through and put on the value line and see. Oh yeah, the high there, $1.10. So we're certainly within that 1% level there. Certainly really strong movement of late. And I can see that a couple of other folks, Ken's put in there that VEI, Vision Eye Institute, is being taken over. And the offer at the moment is at $1.07.5. So a little bit of background to that one there. Certainly a big move out of this sort of sideways consolidation type of zone, moving really, really quickly. So with that takeover there at around $1.07, anything could happen with that at this point in time. But in terms of structure of a trade, if that was out of the equation, then certainly it would meet all the requirements. So well picked up on the the structure, the visuals of that particular trade. I won't put it in under the basis that it is being taken over at this point in time, but well picked up. Folks, do we want to have a look at some of the trades in the US market? We've gone for about 36 minutes. So I can go through and have a look at how things are progressing at the moment. WTM was one that triggered in a couple of weeks ago. 2 weeks ago, triggered in. Last week's candle, not entirely bad. We've had, again, given the broader market movement, still good relative strength, dragging that ATR line up. The very first week that it was triggered, actually, so a positive sign for WTM. We did have a couple of trail stops in the US, CASY, Casey, in particular, was one where just recently its trailed stop. It doesn't look like it on there, but its trailed stop has just come up a couple of cents along the way. And there was one stop out last week, which is on SCI, Service Corporation. So we'll go through and have a look at that particular one there. So this was during that really volatile week at the beginning of September. So price coming way, way down and closing back on its high. Such was the volatility. That was the week that we had the 1,000-point drop on the Dow mid-session. Last week, just closing below its trailing 3 ATR. So on that one, given whereabouts we got into that along the way, I'll see whether there was any opportunities for price volume volatility signals. So there was one soon after we got in, but certainly not taking any profits on any price volume volatility signal where we don't have at least a minimum of 1-to-1. Certainly wanting to take profits once you get past that 1-to-1. We did have another one a bit further along, so getting in at around about $27 odd, $27.20. The next one that occurred was around about $30 at the end of that week. So, the opportunity there to put a little bit in the bank along the way, then being stopped out, exiting at market tonight, depending on where that figure, where that stock happens to open. Ending up still with a profitable trade. It started off very, very nicely. Lots of white candles, etc. But general market weakness of recent times has dragged that one down. Let's go back and have a bit of a look through some of the other ones in the list at the moment. SIRO. This concept of once a soft stop is breached, converting the soft stop to a hard stop. Over the next couple of weeks, I'm just in the process of making some amendments to how we treat our soft stops and whether or not we choose to have a soft stop and convert it to a hard stop. I don't particularly like having a soft stop and being converted to a hard stop because of this very simple fact that once a soft stop is breached, if we therefore put in a hard stop 0.5% below its low, inadvertently we're going to end up, if that gets triggered, with a a much greater loss on the trade than what we set out to originally. So certainly thinking about the use of soft stops, I quite like soft stops, but again, that's each to your own opinion, whether you like to use them or not. I think it's best that you stick with one method or the other. It really doesn't matter too much. But certainly, if price closes below a soft stop, then that would certainly be much more preferential than introducing a hard stop even further down away from where your initial entry was. So I'll certainly articulate that in writing, etc., and let everybody know in terms of how to manage soft stops and hard stops along the way. TSS, that was a trade set up from a couple of weeks ago. It still hasn't triggered. TWC holding up for the time being. VMC continuing to move quite strongly against the broader market. VR, this is an example of a stock that's been triggered in, it's come back down. It has breached its soft stop. It's now got a hard stop in there as an example, down at 42.59. Certainly if we use a rule that says, okay, if the price closes below your initial 2 ATR based stop, therefore we get out, then we'd already be out of this one at this point in time, and we couldn't experience any further losses. This is starting to look a little bit weak up here with the pin bar, and if price does come back down, then the next place that we're going to be stopped out is at 42.59, which is perhaps a little bit lower than what we would have liked. But still, it's still moving along at the moment. Haven't been stopped out yet, so we'll just have to wait and see whether that occurs. VRX, good, nice candle last week, challenging that 3 ATR line for a period of time there. WD40 just moving sideways against the broader market. Really can't make too much of its mind up as to which way that stock wants to go. Same again with Watsco, a lot of sideways movement. Again, 3 ATR, if the market does happen to turn around and move to the upward side, then these stocks that are going sideways will start to get some directional base movement once again. ULTA, this midweek volatility is huge, absolutely huge. Now, again, a case in point, it breached its initial 2 ATR based soft stop. So the rule says we have to put in a hard stop, 0.5% below that level. Well, all of a sudden, instead of having a risk on the trade of around about $13, you're going to end up with a risk on the trade of around what's that? Around $120, around about $50, if that comes down and stops that. So certainly, having a simple rule that if price closes below your trailing 2 ATR, then we're out. As an example, where did that one close? It closed at 159. Our protective stop was at 158.70, so we'd still be in that one. The following week, though, it closed below what would have been our initial soft stop, and so we're out on that particular week. Yes, prices bounce back up. That's you're never going to be right 100% of the time, but certainly a much simpler way of positioning your initial stops. All right, folks, unless we've got any questions, we might leave it there for the time being. We'll have an education session this week. It won't be a live one. It'll be a recorded one, and that'll come out on Wednesday afternoon. So keep an eye out for that. In the meantime, keep doing the right thing. Keep following your plans. Make good decisions. Abide by the market risk. Don't be in a hurry to be placing trades. Protection of capital is very, very important. And let's just let the market evolve and do what it's going to do. And if we need to, let's just be sitting on the side observing what's happening. We don't need to be in the markets all the time. Right, folks, good luck with it this week, and we'll catch up with you live this time next Monday. Thanks for watching.